Greetings. I go by the name of PE ratio, price earnings ratio. And I want to share my screen here. There's some stocks that I like, and I want to share them with you. The first is yeah, 1 second here. Okay, so let me share my screen here. Again, you should listen to me because I love what I do. I've been in the stock market for over a decade, and I always reading financial newspapers like Warren Buffett. I I, I think I'm Warren Buffett. You know what I mean? So I'm always reading and stuff like that. Excuse me. But one thing you want to do is always just you don't what you want. You don't just want to outright buy a company. There's a lot of things that goes into when you investing in the stock market. There's is the company making money? What industry is it in? Is it growing? Something like Nvidia. So we're gonna take the biggest thing called one of the biggest talk now is Nvidia. It makes chips. It makes chips. It makes chips for computers. It makes chips for video games and stuff like that. And let's just go. I was gonna do a start with Sunrun and talk about that first, but let's just go to Nvidia and see what does it do. And when you're on my channel, I have these subscriptions that I'm showing you. They cost me some money, but you all getting it free here. That's why you should listen to me. Okay, so we got this. We'll go to Nvidia. You should always. There's two things that move the market. There's information and expectations. So informations when it's earnings season now. So when earnings season comes out and stocks do good, stocks do well, um, the company start making money when they report their earnings. That is information. So if they beat earnings, you'll see the stock go up. So that's the first one. The second one is expectations, like Nvidia. A lot of people expected this stock to do very well because of what it does. So those two things move the market always. So we're gonna figure out. So what do they do? What do they do? So let's go here, and um, I like this because it gives you financial analysts and stuff like that. So this guy right here name is 1 second here. Um, his name is here. This is rated by analysts. Where is he at? Sorry about that. 30. So 1 second here. So we're gonna go to this is called Seeking Alpha. So we're gonna go to what this analyst is saying. You always want to see what the analysts are saying about your stock. Okay. So if y'all see this, we got Nvidia. It's the so this guy here is Wise Bull, and I'm gonna follow him. At the end of the day, we can't cover like one person can't like myself. I can't cover every stock. So I'm glad when analysts come out and write their and start doing articles on these stocks. Look, I go read them. You always want to know the most reputable analysts out there and start reading from them. So let's just read a little bit here. Come on, this is what I do. Everybody want to know what I do when I'm want to know how to invest in a company, or people want to know what I do when I want to invest in a company. I go read articles, and this thing takes hours. Sometimes it takes a long time. So I'm under the weather. See, y'all gotta excuse me. So here's the summary here. Nvidia has surpassed 5 trillion. If y'all been under, I ain't gonna say that under a rock, but anyway, I ain't gonna say that. So here, Nvidia has surpassed 500 trillion in market cap, outpacing initial growth projections. Y'all want to see my beautiful face? Come on. So, and solidifying its position as the AI market MVP. You got high GPU growth is expected at the current pace, uh, evidenced by the AI, capex spending, and nuclear energy boom. It says Nvidia's PEG. PEG means price earnings growth ratio. So you have PE ratio, which is my name, right? And then you have price earnings growth ratio. It's a ratio that, let's just go find out what exactly um PEG, what exactly is it is. So that way you can for yourself. So what is a PEG in stocks? So it's like a growth. It measures the growth of the company. So the price earnings ratio has value. Here we go. So PEG, price earnings growth ratio, is a metric used to evaluate a stock's value by considering its current price earnings and expected growth rate. It is calculated by dividing the price to earnings ratio by the growth rate of the company's earnings. A lower PEG ratio may indicate that a stock is undervalued relative to its growth potential, making it a useful tool for investors assessing a company's future prospects. Like I say, this is what you get when you're on my channel. This is what you're going to get in my community, my stock market community. This is what you get. Who has time? If you work at a 9 to 5, do you have time to read all this stuff, read articles like this? We're gonna go back to seeking alpha. Come on, let's go. See, I'm just sharing a little bit with you all now, but I'm gonna read this whole thing on a probably by myself. I don't want to bore you all, but if you're with it, come on. This is what I do. High GPU growth is expected at the current pace, evidenced by the AI, capex spending, and nuclear. We right here, nuclear energy boom. So Nvidia's price earnings growth ratio, which we just found out what that was, shows a significant discount compared to both sector median and its 5-year average, unlike Microsoft, which trades at a premium. AI's technology evolution and GPU centric computing in new areas such as robotics, edge computing, and network computing reinforce NVIDIA stock as a top growth portfolio holding with ongoing opportunities ahead. Okay, so here we go. With the key hyperscalers such as Microsoft announcing their earnings, the AI capex spending will be under scrutiny for a return due to their scale and growth speed. However, the main beneficiary, Nvidia Corporation, is expected to continue to enjoy the tailwinds of the AI infrastructure arms race thanks to its undisputed leadership in the GPU um, market that is growing at a rapid pace. GPU, that's something to do with something processing processing unit. Meanwhile, Nvidia's been making recent efforts in expanding AI to new fields such as networking, edge computing, etc. We right here. We right here. Going to the next paragraph. Let me go down a little. Look how long this thing is. But hey, if you want to be a great investor, well, you can just follow me. And in my community, I give stocks and stuff. I give stock market um I give you stock market stuff. So this company right here, after this, just stay tuned. I'm gonna give you the companies that I like. You know, we're gonna touch on them. So this is what we're doing. This first one, we're gonna start off with this one. We just I just wanted to show y'all something about Nvidia. So run. Why do I like run? Okay, here it is analysis. Some people gonna say sell, some people gonna say buy. So even with here, you have Sunrun, a buy on America's next energy giant. So this is a summary. Sunrun is evolving from a solar installer to a fully integrated energy provider, from building a home-based network for power storage and management. I was listening to CNBC on Friday, and I heard this. I think she was the CEO or someone big in this company, and she was saying that they're becoming something like a nuclear plant. You know what I mean? And everybody knows that we need um, we need nuclear energy to be able to run these um, these data centers. So let's keep moving forward. So they're a fully integrated energy provider, building a home-based network for power storage and management. Run's strategic pivot towards storage solutions has sharply improved profitability, liquidity, and the sustainability of its business model. The year 2025 marks a turning point with steady positive cash flow, expanding margins, and expectations for positive EPS after years of losses. Yeah, yes, he's honest. They were losing money. Partnerships with utilities and the development of vehicle to grid programs position Run at the center of America's energy transition. Despite tax financing and technology related risks, Run stands as a mature investment case with strong potential for um, market re rating. Okay. About this article, they have an stock market covered. Okay. Let's keep going. Thesis. So Sunrun is not just a solar company anymore, so it's rebranding itself. It is a story of rebirth. It is gradually transforming into a new kind of energy force that connects hundreds of thousands of households into a network for storage, for storing, managing, and selling electricity. It is a company that within a few years has changed level and now appears ready to move from the era of investment to the era of real value creation. Personally, I think we are entering into one of the most attractive periods for the stock. It is not just the numbers that impress, but the maturity of the plan behind them. The last quarter's Sunrun proves its ability to maintain solid positive cash flow, reduce operating costs, sustain rapid growth, and broaden its profit margins, especially in a sector long viewed as weakening by rising rates and tax exposure. Today, the company serves more than 1 million Americans, having evolved from a simple solar supplier to a leader in home energy storage. If it keeps its form, the re rating of the stock is not a matter of if, but when. Reinvented profitability ahead of earnings. What makes Sunrun stand out in 2025, as I see it, it is the striking change in the DNA of its profitability. In all the previous years, investors thought that the company had growth but no money chasing volume and market share without generating real value. But that picture is different now. The company managed to increase the total value of its contracts and at the same time reduce the customer acquisition costs. And this was a difficult bet that the management won. The result is impressive. In Q2, quarter two, 2025, the company reported a 40% rise in subscriber value, reaching $1.6 billion, while net value created per customer rose sharply to 17,000, plus 182 versus last year. This is the highest result in its history. And this is not by chance. Sunrun has managed to shift its business model towards storage solutions where profit margins are higher. About 70% of new clients choose a solar system with an integrated battery, compared to 54% last year. Okay, so I won't read this whole article to you all, but this is what I do when I'm studying what companies I want to, what route I want to take. This is what I do when I want to decide what I want to invest in. So risk and reality check. Let's read this. This last one for this stock, and then I posted those in my headlines, the companies that I like, so y'all can take a look at them. This is not investment advice. Let's keep going. Risk and reality check. As we all know, there's not an investment story that is invulnerable. Below, I will analyze the company's main challenges. The most important is the tax policy of the U.S. and the continuation of the 48E and ITC incentives, which are a structural part of its financial model. If there are unexpected changes, especially after 2028, returns could come under temporary pressure. Nevertheless, management has acted prudently, securing safe harbor for projects through 2030 and protecting the storage business, which will continue to qualify for subsidies until 2033. The second is financing. Sunrun relies on continuous access to tax equity, and debts secured by its installations. So we always want to know how a company makes its money. If conditions in the capital markets worsen or interest rates rise again, the cost of capital will increase and returns will come under pressure. So if rising interest rates come, then be worried if you're in this stock. However, the company has strong investor relationships and the company to scrutinize assets on favorable terms. It is hard to find another company in the sector with such a stable funding base. A third issue is technology. The pace of progress in batteries is rapid, and anyone who fails to adapt quickly risks falling behind. Sunrun holds the advantage of size and a partnership with leading suppliers, but it must continue to invest in innovation and keep the cost low. And finally, there is always the human factor. The market is full of new players promising cheap solutions, and competition for the end customers intensifying. However, Sunrun holds that advantage of trust. It already has 1 million of active clients who see it not as a supplier but as an energy partner. So it has 1 million active clients. Conclusion: the sun keeps rising. Looking at Sunrun as a whole, I see a company that has left the stage of promise and is entering the phase of maturity. Profitability is rising, the business model is evolving, and the storage market is opening paths that did not exist before. Yes, there are risks, as mentioned above, political, economic, and technological, but the balance is positive. Sunrun seems to have understood something that many have not yet realized, that the future of energy will not belong to a few factories, but to millions of homes that produce, store, and sell electricity, and it is already at the center of this transition. For me, this is one of the most promising buy stories in today's American market, not because it promises miracles, but because it is steadily building the next chapter of the energy economy, a chapter that is only the beginning. Hey, this is what we got to do, right? This is what we got to do. And these other companies, I ain't gonna keep boring y'all with that, but this, I got Tempest AI. I like Pure Storage. Um, Pure Storage, PSTG. It's a $98 stock. Somebody says sell. Um, okay. Let's see what the bears say. He's a bear. Sandpiper investment research. Okay. Let's see this. Let's see this right here. Excuse me. So who are I want to know who are the top um, stock market analysts. Who are the top 30 stock market analysts? That's what I want to know, because you want to know who are the top stock market analysts. That way, if you come across the articles, they're reputable. I want to know who are the most reputable. Who are the most okay? Let's go to another tab here. Who are the most reputable stock market analysts? Excuse me. Well, let's see. Fidelity Investments, Robinhood, et cetera, et cetera. That's not what I was looking for. But here, anyway, that's let's see what this company says. So Pure Storage subscription flag will spin strong, but lofty valuation demands a sell rating. So as we all know, Pure Storage nearly raised 100% over the past year, but the stock now trades at a lofty multiples, leaving little room for error. The company continue, excuse me. So the company continues to deliver steady growth with Q2 revenue up 13% year over year and subscription ARR rising 18%, now accounting for nearly half of total revenue. While the subscription business and deals like Meta highlight strong product adoption, execution risks remain if enterprise demand weakens or product mix shifts toward lower margin offerings. Given stretched valuation, AI driven hype, and limited margin of safety, the risk reward looks unfavorable, making this a prudent time to take profits and move to the sidelines. That's what the Bears say. One of the Bears. Introduction. It's been on a massive rally this year. Um, um, Shares of Pure Storage have been on a massive rally this year, up 61% year to date. It's at 97% over the last 12 months in the latest quarter, while the subscription services business has continued to grow as a percentage of revenues. I have concerns that the valuation and business fundamentals have diverged considerably. At 24 times um, fiscal year 31 earnings, the stock is extremely expensive as spirit animals and AI hype have dislocated from reality. At the 52-week highs, I think the stock is just too expensive and warrants selling. Okay. So it has a P/E ratio of about 50 right now. Um, yeah, it says, okay, short interest at 2%. Okay. Let's see. Growth outlook. Management seems to have conviction in a 2H 2026 acceleration after fiscal year 26 revenue guidance to a 3.6 to 3.63 billion dollar range, which sits 14% above the prior year at the midpoint and 300 BPS ahead of the earlier 11% growth call. For the third quarter, management is guiding for between 950 to 960 million in revenue, or roughly 15% growth, while with operating profit between 185 to 195 million, showing the same mid-teens trajectory. To me, this cadence tells me the pipeline has thickened enough over the summer to bank on sequential momentum rather than hoping for a typical Q4 spike. Okay. Um, so that's what the Bears got to say about this. I mean, Bears are entitled to their own opinion, right? I'll follow him. What's this guy? What these people saying in the comments? If peer storage products are adopted more widely, estimates will be blown away. If it's only meta platforms, then it's overvalued. So people, I could comment here. I'm gonna say thank you for the advice. Thank you for the advice. I gotta put a picture right there. You know, thank you for your patience. Your comment is being reviewed by our moderators. Oh, it's being reviewed. So if I don't say what you want me to say, then what? Huh? So that's for Pure Storage. Let's see what one of the Bears say about it. I mean the Bulls say about it. So that was yesterday's. They that was yesterday. So that was Sunday early morning. They did a take on that. So Pure Storage. This was September 3rd. Why Pure Storage continues to shine at buyer's perspective. You know, Star Investments. So, summary: Pure Storage QT hyperscaler wins and subscription growth drove a 32% post earnings stock surge and outperformance versus the S&P 500. Collaboration with Meta and early stage talks with other hyperscalers signal for further upside potential. New hyperscaler design wins could be a major catalyst for future growth. Subscription revenue now comprises 48% of total revenue, with ARR and RPO growth outpaces subscriptions, indicating potentially accelerating future revenue and higher valuation potential. Despite premium valuation metrics, rapid EBITDA growth, expanding margins, and excellent long-term AI infrastructure positioning justify a continued bullish outlook for growth investors. Come on. So this is how I analyze my stocks. This is one of the ways I go. I have to, after checking the financials, after seeing what sector is in, I also have to come in and see what the analyst says about the stock. I have to do a lot of reading, a lot of research. You don't have to do that. Well, you should, but I'm teaching it, so of course I'm gonna have to be like on this. You know, in my community, I can show you shorter ways on how to analyze, stocks and stuff like that. But me, I have to know what's going on because I'm looking for the next big one. Additional reasons to remain invested. Okay. Y'all can pause this and read this. I'm not gonna go through this. I'm not gonna bore you all. There's a lot of they can write. They can write. 1 second here. I got access to a lot of other stuff too here. So again, once you join my community, I have owned for 5 years and happy with the performance. I am trying to digest some of the metrics. Only 14% projected revenue growth seems low for such a high PE rate company. So again, I got, let me see, top dividend stocks. So I got access to that. Y'all need to come on and deal with a player. Yes, sir. Y'all need to come on over here and just deal with me. This is what I do. This is what I do. This is what I do. Here, Noah gives you a 10% annual dividend, so that I ain't gonna leave y'all without nothing, right? So here's Noah gives you a 10% dividend. And so that may be something you all want to look at. 10% dividend. The company is cost $11 to buy. I'm gonna look into this some more, and they pay you a dollar per share each year. So 10%. So if you put $100,000 in, 10% of that is let me see, 10% of 100,000. Let me do the math real quick. Isn't that, yeah, it's $10,000 if I'm not mistaken. But I gotta check to see if the company is worth that. So $100,000 times 10%. So just move, either divide 10 by 100 or just move 2 decimal places to the left, which is, so that'll be 100,000 times point 010. No, 100,000 times 0.10. It's $10,000. So if you had $100,000 to put in this stock, you'll make $10,000 every single year. In 10 years, you make your money back and then some. So they got the rule of 72 that says 72 divided by the dividend yield, and whatever that number equals, that's how many years it'll take to double your money. So 72 divided by 10 is 7.2. So they saying roughly around 7.2 years, you'll double your. That's how much it takes to double your money. So that's the rule of 72. But I'm gonna stop sharing this, and y'all have a good night. that's it for this. I went a little longer than expected, but uh, there you go. So peace.